I'm going to give you 5 reasons why you should buy the stock Citigroup. The symbol on the New York Stock Exchange is C. Reason number 1. They've been in business for 105 years, surviving all kinds of political problems, trade wars, and all kinds of Great Depressions, recessions along the way, and they've made it through all of that, growing along the way. If you start at year 1 and extrapolate out until now, you would have $600 million in additional revenue starting on year 1, 2, 3, 4, 5, all the way up to year 105 until they get to $63 billion in revenue in 2017. Reason number 2, the balance sheet. If you go down to the equity at the bottom of the balance sheet, you'll see that Citigroup has $200 billion in equity. That's a great number, but that only matters in relation to the market capitalization. If you look at the market cap on Yahoo, you'll see that Citigroup is right now worth $175 billion. So, if you bought the entire company, all of the shares of stock right now on the stock exchange, you could buy the company for $175 billion, turn around and liquidate the entire thing tomorrow and end up with $200 billion. That is a $25 billion additional profit over buying and selling a company. So why don't they just close the doors? Well, of course they have all kinds of employees right now that they don't want to just fire to close the doors, so there's no way they would do that, and they're making additional revenue. They're not losing revenue every single year. Reason number 3, goodwill and intangible assets. Right now, Citigroup has $25 billion worth of goodwill and intangible assets, of which 22 is goodwill. Goodwill happens when you buy a company for more than the book value, more than the equity on their balance sheet. If a company like Citigroup has $200 billion on their balance sheet in equity, and a company buys them for $225 billion in cash or in stock purchases, no matter how the deal goes down, they would end up putting $25 billion into their goodwill in hopes that the income from Citigroup would add to the income from on their income statement and then get onto their balance sheet. So it kind of subtracts itself over the years, but that's where goodwill comes from. So if I bought the company today for $200 billion and Citigroup has $175 billion of net tangible assets, and I tried to turn around and sell the company and liquidate it, I wouldn't be able to just go find that goodwill and sell it on the open market. There's no one to buy that goodwill. The goodwill comes from the future income of the company that they bought. So right now, Citigroup market cap, you could buy the entire company for $175 billion. The balance sheet says that they have $200 billion in equity, but if you subtract the goodwill and intangible assets of $25 billion, that 200 goes down to 175, which means this is a very rare situation in the New York Stock Exchange. You can buy Citigroup, all of the shares right now, if you have $175 billion. You could turn around and liquidate and get exactly $175 billion. So the positive thing to that is the net income going forward into future years that you will continue to get. Reason number 4, the income statement. There is a hidden jewel in Citigroup's income statement right now. If you look up their earnings per share ratio, it shows that it's negative. It looks like they're not making money, which is very strange. So if you don't dig into the financial statements, you will not understand why Citigroup is actually making positive income. There was a big tax reform at the end of 2017, and Trump was initiating something where you could repatriate your money from other countries back into your home country and be able to have a lower tax rate on it. So right now, Apple is a company that makes millions. Apple makes billions of dollars in other countries, and they don't bring it back to the United States because the United States' highest tax bracket is almost 40%. And if you're paying 20% tax as you make money in another country, and then you reinvest it in that country, you'll continue paying that 20% tax. But as soon as you bring all of those profits back to the United States, you're going to have to pay the additional difference of 20% tax to end up breaking even. So they don't do it at all. They just leave the money in those countries and let that reinvest itself into those countries. However, the most powerful economy in the world is the United States. So it would be nice if they could bring that money back to the United States to put it into research and development here, turn it into an investment and make money here. However, with that additional 20%, sometimes only 10% tax, they don't want to bring it back because it turns into a negative income. So they're just leaving cash basically sitting in banks in other countries because they don't even have the power to reinvest it there. So it's a bit of a weird, awkward tax situation, but Citigroup decided to bank on that. They decided to pull billions of dollars from other countries back to the United States, and they paid a $22 billion tax fee, which ended up on the income statement and showed a negative loss on their income statement for last year. And if you actually go to the financial statements in anyone like Yahoo Finance, you go to the income statement and you look down and you dig in quarterly, you'll see that they went from 3.6 billion to 4 billion to negative 18 billion back up to 4.6 billion. So they're making over $4 billion per quarter, and all of a sudden they had that one quarter that looks very fishy and they lost a ton of money in that quarter, and that is simply because of a tax break that they took to bring money back to the United States, which obviously means that they have a plan to use that money and reinvest it into the company somehow in the United States, which they haven't released yet. So if you buy Citigroup right now, you're going to look at a negative earnings. So I wouldn't recommend putting all of your money into Citigroup today, because I think that a lot of people are going to see that negative earnings per share ratio and they're going to probably back out of that company. That doesn't mean that the stock is going to plummet tomorrow. I think that dollar cost averaging into this stock over the next year is going to be an unbelievable, great investment, because the earnings per share is going to make people back out, which means the stock is going to continue to lower. So if you continue to buy it on a monthly basis for an entire year, while that negative $18 billion quarter goes kind of off into the dust, and their earnings per share all of a sudden becomes positive and it becomes very big, a lot of people are going to turn around and see that next year and say, I should get into that stock, and it's going to start bringing it back around. So this is a long-term idea, but the equity, the positive earnings, on top of the fact that you can break even on that book value compared to market cap, is just such a great investment right now. Reason number 5, the cash flow statement. If you look at the cash flow statement near the bottom, it shows financing activities, and you'll be able to see their dividend and you'll be able to see their stock buyback program. Their stock buyback program over the past 3 years has averaged $7 billion per year. So you can buy a few shares of stock, maybe you can buy 1,000 shares if you have a decent amount of money, and you might take the next few off of the New York Stock Exchange. But imagine buying $7 billion worth of any company in 1 year. The stock price is just going to start going up and up and up, and people are going to get more excited about it, and other people are going to start jumping into it. So $7 billion per year over the last 3 years has really helped this stock go up. And if you look at the last 3 to 4 years, you can say that the stock price went up because of Trump, because of the election, because of the good in the economy right now. You could say numerous amounts of different reasons, but the fact that they put $21 billion worth of their money into this stock over the last 3 years has to mean something positive as well. The second part of the cash flow statement is the dividend. They've been offering a 2% dividend for quite some time now. They're putting about $4 to $5 billion or so into their dividend program every single year. So if you're a shareholder and you wanted a dividend, if you bought one share for about $68 right now, 1% of that is 68 cents, and if you double that, you'd be at about $1.30. So for every one share of $68 that you buy, you'll get $1.30 every single year, which means if the stock stays stagnant for 5 years, or if it even drops a little bit and your stock has gone down, your investment has gone down, you're still collecting that 2% dividend along the way. And if you wait for it to start going back up, at least it's a reassurance that the company is giving you something back and that you're not just owning it for no reason. 90% of the newest tech companies do not offer a dividend. Their claim to fame is that if you're paying a dividend and you're buying back your own stock, then you have no ideas on how to use those billions of dollars to reinvest it and grow the stock price instead. And I can't possibly agree with that, because a lot of the stuff that Amazon and Facebook are doing right now, they're just reinvesting into the future, and I understand that, but they're just growing so rapidly that something's got to just tip it the other way for even a couple of years, just to bring the stock price back down to reality and in comparison to their balance sheet, because Amazon and Facebook's balance sheet just do not compare to the market cap even in the slightest bit. They make a lot of income, but it just does not compare. The income has to end up on the balance sheet. It's just like if two people, one person makes $75,000 per year and one person makes $100,000 per year. Everybody would rather be the person who makes the $100,000 a year if they could pick one of them. And if you had to invest in one of them, you would probably pick the person that makes $100,000 per year. However, that person who makes $100,000 per year could really be a car enthusiast rather than a house enthusiast. And if they buy cars to put them in their garage and they continuously deflate in value, all of their $100,000 is going toward that, and none of it's going into their savings account. Versus the person who makes $75,000 per year, he's much more frugal. He or she is much more frugal. They put money into their savings. They buy a house as a rental property. They put money into index funds and into their IRA, while the other person is buying cars that are deflating in value. So there's a bunch of different differences about how somebody takes their income statement and turns it into their balance sheet. And that's just like a person's salary turning into their savings account. So just because a company makes more money doesn't mean that it turns into more money on their balance sheet. And that's the savings account is really where the company is worth. If they liquidated that company today and Facebook had to sell all of their computers, they can't sell their customer data as an asset. So if they wanted to actually sell off, they would not end up with anywhere close to what their market cap is right now. But Citigroup can. Citigroup, you can buy it for $175 billion and you can turn around tomorrow and sell it for $175 billion. So that's risk-free. That's like buying a house today for $175 billion and then turning around and selling it tomorrow for $175. Sure, there might be some fees along the way of buying it and selling it, just like there are with a company, but you would be able to get your money back. If you bought Facebook today in 2018, this is June in 2018, if you bought Facebook for $550 billion, you would only be able to turn around and sell it tomorrow for $50 billion. So you better hope they're making a lot of money to get you that money back into your savings account over the years so that you can get your $500 billion back. And if you only buy one share, that's exactly the same as buying all of the shares. So that's why I'm talking about buying the whole company.